What's the deal, big dog? I'm so glad to have you here inside of Module 2, where we're going to be going over the mechanics of options trading. In this module, we're going to dive into the practical aspects of options trading, and we're going to explore some trade execution. We're going to add in a little bit of the market dynamics, and we're going to put a little splash of some hands-on practice in the mix. So let's get started, shall we? So, first and foremost, we have placing our options trades. First thing you're going to do is you're going to select your option. You're going to choose the underlying asset, the expiration date, and the strike price. You're going to consider your market outlook as well as your risk tolerance. Then we got choose your order type. You're going to decide between whether you want to select a market order for immediate execution, or if you want to go ahead and go with a limit order to control the price, pinpoint exactly where it is that you enter at. Then we got review and submit. Make sure that before you jump into the trade, you're going to double check all the details, including the contract specifications and the potential fees included. After that, you're going to submit your order when you're ready. Now, we have understanding bid-ask spreads, because you're definitely going to need to know this. So, first thing we got is the bid price. Now, the bid price is the highest price a buyer is willing to pay. It will always be lower than the ask price. Then we have the ask price. Now, the ask price is the lowest price that a seller is willing to accept, and it will always be higher than the bid price. And then we have what is known as the spread. Now, the spread is the difference between the bid and ask prices. Now, tighter spreads indicate higher liquidity. And one thing that I wish that I knew when I first started, when the bid and the ask are too far separated, that means that those are the ones that you want to stay away from. Now, we have the roles of the options exchanges themselves. So, we got price discovery. Now, the exchanges facilitate fair and efficient price discovery through open market competition. If it wasn't for them, we'd have nowhere to purchase our contracts through, seeing as before all of this digital and online stuff started, you would have literally had to go to the trading floor in order to execute trades. So just think about that. Then we got order matching. Now, what they do is they match buy and sell orders, ensuring timely and accurate trade execution. If I had to go find my contracts to sell them to myself personally, it'd probably take me a year and a half. Then we got regulatory oversight. Now, exchanges enforce the rules and regulations to maintain market integrity as well as protecting the investors. So, the only way that we can mess up on a trade is if we push the button at the wrong time and it goes against us. You'll never be able to say, well, the market did this and the market did that. No, the market makers, the options exchanges, they make sure that everything is done when you want it to be done, as far as the way you're selecting your options contracts. That's why it's very important to understand how it is you're executing these trades and know what it is that you're doing before you just start putting your money up and hoping, throwing money at the wall and hoping something sticks. And then we have information dissemination. What they do is they distribute real-time market data, enhancing the transparency for all market participants. Now, so instead of you just having to jump into a trade blindly, not knowing how much it costs, how much you stand to gain, how much you stand to lose, all that information is available to you, readily available to you before you even jump into the trade. So, we got paper trading. So, the first thing you're going to have to do is you're going to have to open up a paper account. Now, what you're going to do is sign up for paper trading for a paper trading platform that allows you to trade with your virtual or paper funds. Then we got research and plan. You're going to analyze market conditions and develop trading strategies without real risk. That's what paper trading allows us to do. Instead of you just getting started without knowing anything and just putting your hard earned money at risk, first starting out the gates, what paper trading allows you to do is it allows you to learn the lessons without the scars. So instead of you having to learn how to trade using your hard earned money to do so, you can learn how to trade, just the trading side of things, from paper trading. You can include certain things once you get into your actual real money account. But I always suggest that when you're first starting, you always want to start with paper trading because it's going to allow you to learn those little those little lessons about options trading that it would have been much easier for you to stomach had it not been for your hard-earned money being on the line. You know, it's called paying that ignorance tax down because it's not the things that we don't know that hurt us, but it's the things that we don't even know that are true that hurt us the most. Then we got executing your paper trade. Now, what you're going to do is you're going to actually place your virtual orders and monitor their performance in the real-time market conditions. Same way you would when you in trades with your actual real money. It has the same exact everything to it, except for the fact that if you lose money, you don't have to feel like your stomach is in the bottom of your gut. And then we got review as well as learn. Now, what you're gonna do is you're gonna analyze your virtual trades to try to figure out and identify some of your strengths as well as your areas for improvements. Because let's be real, we don't learn the best lessons from our wins. We actually learn the best lessons from our losses. So, with that being said, I look forward to seeing you inside of Module 3. Love is love.